Welcome here to the sneak preview on CT11A for our Q3 results. As you are aware, we are transitory year this year and well on track. Well on track means in our core business, in the mortgage world, the recovery of the market is proceeding a third quarter in a row. Our predicted crisis time of 4 to 8 months is coming to an end, and we saw an uplift of volume now for the first 9 months of 20% in the market. Reasons for this recovery is our stable macroeconomic environment. We have slightly lower interest rates compared to last year and pretty stable around 3% for a 10 years mortgage. We have well-equipped stock of properties on sale. Actually, I think there's still quite a number of properties available if the price recovery continues as it's ongoing. So prices up roughly 5% in the beginning of this year in average here in Germany. So we are on track back to normal as well from the pricing perspective. And for this year, you can say it doesn't make sense anymore to wait as a potential home buyer to act. What is not in line is the construction costs. You see the huge gap between existing homes and new constructions. This leads still to a quite depressed environment for new constructions, a part of the business we usually would have. Okay, what is important for you to understand is a massive change in the German housing sector. Usually Germany has a huge renting part. The renting is depressed and stays on a low level and will stay on a low level thanks to massive regulation. Current level of home ownership is 44%, 56% is renting. And over the period of the next years, a significant shift because of the availability of renting units. So the low level of available is a positive vector for the housing market and the home ownership market and the mortgage market, which we are in. So Q3 and recovery process on the Europace platform in transaction volume. What you can see is with the red columns, that purchase is already back to normal when we talk about numbers and especially volume. Keep in mind that this is still an ongoing process of recovery. So we will see higher numbers than the peak in Q1, thanks to market share gains by Europace in our sectors and thanks to the decline of the renting opportunities here in Germany. Where we still wait for a recovery, construction, new building column, as well as the refinancing part, where we'll have to wait until 2027 when the typically 15 years fixed interest rate mortgages from before 2012 due to. And what we are still lacking is reconstruction of existing homes and improving of energy efficiency, something where we need 20 billion investment per quarter to meet our 2045 or 2050 goals of carbon net neutrality here in Europe. And with the current level, we will not achieve this. So there's additional volume needed compared to the currently still compressed level. So all in all, just recovery in progress, you can say, in which we outperform the market. The 20% market volume uplift compared to last year results in 23% more transaction volume on Europace. Significant market share gain, especially when you know that Deutsche Bank, our core client, left the market last summer because of huge IT restructuring and they still didn't come back. So we compensate fully our largest client, plus outperform the market. And this mainly thanks to the savings banks and cooperative banking sector, where we gain significant market share and improve our migration path, the intensity of marketing there. In total for the segment, we see an uplift of 36% in revenue. There's a certain level of dilution in this because we offer our group buying power to non-group companies as well to slightly increase our margin. But this is pass-through commissions which inflate our revenue. Our gross profit is the better number to look at right now, plus 18%, including some weak numbers from our valuation business. Details about this you find on our investor relation environment. Okay, but for Q3, already 20 million in EBIT. Again, if you exclude the valuation business, 27 million in profit. So we are well on track back to high double-digit profit numbers to gross profit. We saw 40% plus before crisis. We will come back to this pretty soon. Beside this, two smaller segments. One is financing platform with everything what we do in other credit markets. Here we still struggle with the current market environment in Germany, especially in the corporate environment and the municipal housing environment. In both markets, the recovery did not start. So different than the private mortgage business, so small plus numbers for now. And we have the insurance business, stable market environment, and not infected by the turbulence in the interest rate environment, as well just a small revenue growth in an environment where we focus on cost saving and stability from a perspective of profitability. So third quarter in a row, profitable here, and we set the base here for next year, significant profit distribution as well from this segment like the others do already. In total, transitory this year, we are still a certain level away from our all-time high in 2021, but on path to reach this record high level in one of the next 2 years. So good moment to really understand Hypoport, to check it out. And let's say, just to be aware, we still keep investing in a lot of innovative projects and subsidiaries, which is part of this, our current P&L and the 38 million in profit for now. Recovery process of mortgage business and the mortgage market, well on track. We see that our market will come back to a 75 to 100 billion per quarter volume market, faster than the lines in white and red indicates here. You see the recovery ongoing right now, not as fast as the drop was, but we are coming back step by step in this market. Okay, we stay with our current forecast, 10 to 20 million this year. Next year, expect high double-digit growth rates, thanks to the low level we are now. And latest in 26, a new record year for Hypoport, just based on the current dynamics we see in the market. So please dive deeper and see you soon here again. Bye-bye.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.